bonjour. My français c'est très mal, so I speak English. I apologize. But I'm going to talk today about how the internet is changing everything we value in trade, finance, life, and relationships. Everything that we think of as valuable is now being digitized. And by doing that, the way we think about money and the way we think about currency, the way we think about our lives changes. I focus upon money, which is obviously a good thing to focus upon. But money is no longer about profit and trade and commerce. It's about relationships and values and favorites and likes and shares. And that's come about because we're in what I call the sixth phase of the internet and the third generation of the internet. And so what I thought I'd do today is just talk you through 10 phases and 4 generations of network development. And the sixth phase has taken about 30 years to get to where we are today. There's 4 more to come, which will take about another 15 years. And hopefully you'll find that interesting. The first phase was actually in the late 80s, early 90s, when we were actually building the internetwork, the internet itself. So Banyan Vines, Ethernet, TCP/IP, HTML, www, dial-up lines, broadband. You know, getting onto the network was the key thing. Once you're on the network, the second phase is what do you do when you're on the network. And in the early to mid-1990s, we saw a lot of information services and advertising services coming from companies to say, here we are, this is what we do, here's our online magazine. And to find those magazines, you needed search engines. So we saw Yahoo and Ask Jeeves and Lycos and others appearing, until eventually we got a system where you could find stuff, then you could buy and sell stuff. So by the end of the 1990s, we started to do trade on the internet. And we saw Alibaba, eBay, PayPal, and various services appearing, Amazon, to allow us to buy and sell on the internet. But right now, during that 10-year, 15-year cycle, we were not really seeing that much that was amazing because it was all about control, companies providing services to us, one to many. And so it was all about building access information and commerce between businesses and consumers. Then it got really interesting in the last decade, in the 2000s, because we moved ahead into sharing what we actually felt, what we believed, what we thought, through blogs and through videos on YouTube and TypePad. And once we could share about things, we could care about things. So we saw the rise of the social network and the massive growth of Snapchat and Facebook and Twitter and LinkedIn, for those who are boring. And finally, therefore, we got into this many-to-many network where we could all share one-to-one lots and lots of stuff. And that was good too, because it democratized the internet, the word that's been used many times already in the last day and a half. But right now, we're in the most interesting part of the network development because we're in what I call 3.0, because we are moving into something that's very different. And for me, having worked in technology and financial services most of my life, this is the most important change for me because it redefines money. It redefines how we think about the exchange of value. It's the value web. And the value web really is enabled by 2 key technologies. The main one is the mobile network, the fact that we can share person to person across the planet directly in real time. And that's a phenomenal change because the key thing about the mobile network is it's not in the hands of the few, it's in the hands of everyone. Until the last 10 years, 5 billion people were not on the network. Therefore, they couldn't get access to value exchange because they didn't have access to bank accounts. Now everybody is on the network. Everybody on the planet can communicate one-to-one in real time, globally. That is a transition that's amazing for the way we think about how we exchange value and how we relate to each other. Because everybody, 7 billion people, can now talk to each other, do trade with each other, deal with each other, one-to-one. Now, for the developed economies, the big challenge of the mobile network in the financial system is what the hell do we do with our old banks? Because we built them for the physical distribution of paper in a localized network that was based around branches and bricks and mortar. Now we're dealing with the digital distribution of data through the globalized network. How do we do real-time when we're batch? How do we do remote relationships when we think of them as face-to-face in branches? That's the fundamental challenge for the developed economies. But that's not interesting, because that's actually not really where the action is. The action is in what's happening with those who never had bank accounts. Those people in Africa who never actually were on the network. The Kenyans who now wonder what the hell you're talking about when you say a credit card, when we deal with the mobile phone. You know, what is it that you're talking about when the world has developed beyond the old financial system, the old value exchange system, to the mobile system? And what's starting to happen is that people who are poor can now transform their lives because they're included in the network. And this is the vision of Bill and Melinda Gates Foundation. Bill Gates made a statement a couple of years ago that by the year 2035, no one will be poor because the system makes them poor. You know, maybe because of war or disease or other issues, but it won't be because they're excluded from the system, because everybody will be on the system, the network system of value exchange, of the value web we're building right now. In fact, in this year's foundation letter from the Bill and Melinda Gates Foundation, this big bet is that people in poor countries will become wealthier far faster than in any other nations. So in Africa, in the emerging economies in Asia, in Latin America, we'll see a lot more people becoming not rich, but raising their standards of living. And it's all about mobile financial inclusion. That's what's happening. Mobile financial inclusion enables people to get access to services they never could before. From The Economist the other day, 7% of the 4 million businesses in Mexico make up 95% of all the companies. And they've never had access in many of these areas of Mexico to banking systems. Now they have a mobile financial system that gives them mobile microloans, that enables them to access services they never had access to before, because before there was nothing there. There's no bank in a lot of the communities in Mexico because they're remote. Now the mobile system includes all of them, so they can become transformed. There's an interesting example of a transformational service already out there called TransferWise. And it doesn't quite work the way they claim it works, but if they could do this, this would be phenomenal. Because the way they claim it works is that if I want to transfer money between people, then traditionally I do that by moving money. They do it by moving data. So if I want to send 100 euros to Francois from London, which would cost me £80, let's say, and Thierry wants to send £80 to John in London by putting 100 euros into the system, what TransferWise does is gives the £80 that I'm putting into the system to John, and gives 100 euros that I wanted to send to Francois from Thierry. So it just moves data. No money moves. No money moves. As a result, it's free, almost. When you look at how banks work, banks charge a lot of money to do this. TransferWise does it for virtually nothing, because it's just moving numbers. And money is just numbers. Money is just data in the network of the value web. What's going to be amazing is if, as rumored, Facebook combines in a partnership with TransferWise, so that anybody on a social network, 1.5 billion people, can just move data around as money. How does that change the game? Fundamentally. In fact, the fundamental change of the mobile network is that everyone can not just make payments, but they can take payments. So when everybody's phone becomes a point of sale, then you also have a big, big change in how you think about things. By way of example, this guy is on the M-Pesa page of the Kenyan website for M-Pesa Safaricom, which is one of the biggest mobile money networks in the world. 43% of Kenya's gross domestic product moves by mobile money transfers. 8 years ago, nothing moved by mobile money transfers. 43% moves today through mobile money transfers. But in particular, this guy can now sell milk, leather, meat through the network. So before, he could only sell his cattle and goats and goods and services to the local community in the plains of Kenya. Now he can sell across the whole of Kenya, or the whole of Africa, or the whole of the world through Instagram. through Facebook, through text messages, through tweets. Everybody's on the network. And you may think, but he's surely not using an iPhone. Hey, iPhone 2, we threw ours away. They're out there. But to do that, you have to have some form of currency that's also cheap, free, and real-time. And you think about the banking system, the financial system, it takes a long time to move money. How long does it take you to get money from Paris to São Paulo in Brazil? I recently received a payment from São Paulo in Brazil. It took 10 days. That's disgusting in the age of real time. If I'm phoning someone, do I expect them to pick up the phone 10 days later? Come on. So the financial system is being re-architected as we speak, and it needs a digital currency. And the one that everyone's talking about is one that you've heard a little bit about already. Who invented this? Who invented money? Who invented this exchange of value? Who did this? Well, actually, it wasn't God. It's Satoshi Nakamoto. And the invention of the digital currency of Bitcoin, which is the one that's got a really horrible reputation, is not the currency, but the technology of the blockchain that Satoshi Nakamoto invented. That's the second transformational technology of the value web. Because when you look at Satoshi Nakamoto's paper from 2009, the original paper made a clear statement that we need to send money peer-to-peer in real time, immediately, in a trusted network with no third-party financial institution involved. In other words, the vision of the Bitcoin white paper was to wipe out the banking and payment system, to eradicate it, decimate it, get rid of it. We don't need it. Now, banks have finally woken up to the fact that that's a little bit of a threat. So they're actually starting to work with it. And what we see happening is a lot of banks talking about the blockchain technology. New York Stock Exchange, USAA, BBVA, Santander, UBS, Barclays, they're all investing in developing this technology into their core back-office operations to allow the exchange of value in real time for almost free. You think about the banking system. If you want to make a payment on a Sunday morning, is it immediate? Is it real time? Is it free? No. It's going to take place over maybe 5 to 10 working days. It may cost you several euros, maybe hundreds or thousands of euros, and it's a pain in the backside. On the blockchain in November, an $86 million transaction took place on a Sunday morning. It took 10 minutes to move globally across the network and cost virtually nothing. That's the power of this new technology. And that's the reason why the banks are saying, you know what, we could use this for lots of things. Santander brought out a white paper about a week ago and said there's about 25 ways we can see that we could use the blockchain in financial services to do security settlements, real-time trading, to provide real-time clearing and settlement for small or even high-value payments, to even record contracts. There's a couple who got married on the blockchain. They recorded their marriage vows on the technology because this is an immediate transaction system that records irrevocably what happened between two counterparties, which could be two banks or two individuals. It's the reason why legends of the industry like John Reed, who ran Citibank and built it into a global behemoth in the 1980s, says that if you think of money as just a ledger system of debits and credits, this is the most sophisticated one we've ever seen, because it's a digital one. We never had one before. Dee Hock, who created Visa, believes that this is not just the future of money, but the future of governance, because you can record irrevocably any contract between two people. So by way of example, there's a development right now in several countries, I'm involved in a couple of them, to create the land deeds record system for that country on the blockchain. You think about the mortgage process, the house sale and buying process, it's all legal and lots of lawyers involved and solicitors and paper and conveyancing and recording of documentation. Why are we recording documentation in a digital age? We live in a digital age. Record it on a digital ledger system. That's why this is so important. It's why so many companies are starting to form around the new value exchange mechanism, the new value web, this 6th generation in a sixth phase rather, in Web 3.0 of the internet. Figures vary immensely, but let's just say there's a lot of companies out there doing a lot of stuff. Last year, there was about $13 billion invested in Fintech startups. The year before, $4 billion. The year before, less than $1 billion. This year, about $30 billion. Why are so many venture capitalists investing in Fintech? Because Fintech replaces financial systems. Financial systems were built around paper. Fintech is built around the internet. So you replace the old system with a new one, means that there's a lot of people who want to be in on the action. That's why everybody's investing in Fintech, because they can see this is the biggest change in our world since the internet came about. If you look at the fact that it's all over the place, the biggest area where this is happening is in payments and in lending. And you can see why lending is being replaced by Fintech. Because if you look at the old way that banks do business, this is the fundamental way a bank does business. They take deposits, they look at the risk of lending those deposits out to people and companies, then they lend it out at a premium. That is the basics of the financial system we built. Take money in, manage the risk, lend it out. When you replace the buildings and the humans with software and servers, the basis points become much leaner, meaner, and slimmer. In the old system, if we're working at a 4 percentage point differential, if the software and server can operate at a 1 percentage point differential, that wipes out our old competitive structures. We're not competing as the old financial system. You can't compete with a digital system. And that's the reason why Fintech's being invested in so heavily. It's the reason why this is a fundamental shift. It's the reason why, as quoted yesterday by Salim Ismail, businesses built in the 20th century will fail in the 21st century if they don't completely reconstruct themselves. Banks and insurance companies and wealth managers were built in a physical distribution system of paper. Now we live in a digital distribution of data. We've got to shift it completely on its head. Goldman Sachs came out with a report just in February. They came out with several, actually, but this is the one about lending. That forecasts 7% of bank profits will disappear in the next 5 years to these new financial systems. What's interesting is now Goldman Sachs has launched a peer-to-peer lending system. They're getting in on the action. In fact, a lot of banks are trying to get in on the action. Because right now, this is a very small system. There's loads of people out there doing credit, crowdfunding, crowdsourcing, peer-to-peer lending. But if you look at the numbers, it's diddly squat. I mean, it's just 1.5 billion euros last year. Banks funded 926 billion. So banks have almost got €1 trillion of lending to small businesses. These guys are doing 1 billion. It's nothing, it's peanuts, except that tomorrow it's everything, according to the venture capital funds. Tomorrow it replaces everything. So we've got 10 years to change for those who are banks and insurance companies in the room. What are we going to be doing? How are we going to change? When you think about the current structure of financial services, everything is on a homepage and integrated and bundled. We think we do everything, because in the old world of physical distribution of paper, we controlled everything. In the old world, we manufactured the stuff, we distributed the stuff, we processed the stuff. In the new world, everyone says we can process some of the stuff, we can distribute some of the stuff, we can make some of the stuff. You don't need to be getting it bundled from a bank. That's an old mentality of the 20th century. Unbundle everything. Reconstruct everything. Make everything a component. Think of it differently. Just a few examples of how quickly things change. There's a great service in America for social payments called Venmo. It's only 4 years old. And it was created by 2 guys who were developers, coders, who had a passion for trying out different things. And they got together for a weekend on a Friday, and at the end of the weekend, one of the guys didn't have any money, so he had to pay back his bill to his mates, and was writing a check when they thought, you know what, why the hell are we writing checks to each other in the 21st century? We both use PayPal. Why don't we just code something together based on PayPal to make the payment between us really easy? A social payment. And that's how they built Venmo, over a long weekend enjoying themselves, and click, got the idea. Just get rid of the check. Let's just pay socially via an app. They were bought a year later by Braintree, and Braintree were bought a year after that by PayPal. So this social app, invented over a weekend in 2011, is now processing millions of dollars a day. In Q4 last year, Venmo processed $900 million in social payments. The quarter before, $700 million. So you're looking at this growing exponentially to being a multi-billion-dollar payment system that replaces traditional ways of sending and paying money, just created over a social weekend as an app. It gets rid of old ways of thinking. In fact, it's funny because I mentioned that this was bought by PayPal. PayPal's legacy. PayPal's 16 years old. It's about to be spun off as a separate company. But when Apple Pay decided to create the wallet Apple Pay, they partnered with Stripe. And Stripe is a unicorn. It's one of these 36 new startup fintech companies that are worth over $1 billion. They only started in 2011. So again, a very new company, worth over $1 billion. For those who heard Michael Hart's presentation yesterday, the 36 fintech unicorns that include Zopa, Prosper, Lending Club, Stripe, are now worth more together as a valuation than Barclays Bank, the 4th largest bank in the world. 36 fintech unicorns, 36 fintech startups that are worth over $1 billion last year. The year before, there were only 12. That's why the VCs are investing. This is the new market. This is the reconstruction of the financial system for the exchange of value real-time, globally, anytime, anywhere, between anyone. This is the new value web. And yet Stripe are coming over here and saying that we need to beat someone up. And who they want to beat up is Europe's hottest fintech firm called Clarna. And Klarna is really interesting because I talked to them the other day, and they said, we're not worried about Stripe because all they're doing is sitting on the old system of Visa and MasterCard. We've reinvented that system. If you don't know Klarna, then basically what they do is use the electoral roll with your zip code or postcode so that you can order anything from anybody and you don't pay until you get the product. It's a wonderful idea because how often do you get something and you go, that's not what I ordered. That's not what I thought I was buying on the internet. With Klarna, you buy it, you get it. If it's what you wanted, then it's really easy. You just pay them. It's really simple. And they've taken away all the risk of the sale, and they make it really easy. So one of the key things about Klarna is they make the focus upon the merchant getting more sales and the consumer feeling more confident buying, rather than looking at the risk of the consumer not paying or defaulting, which is what banks do. It's not risk mitigation, it's internet sales, the value web. So I keep saying that fintech is this new value web because it's designed for the digital distribution of data in a globalized network to exchange value, rather than the way we used to exchange value in the physical network of the local branch, which is the old way of doing things. And this is where we start to say, well, what do I actually need to do about this if I'm a bank or insurance company or wealth manager? What do I have to do? I've got to change. We all know we have to change. And I don't have the time to go through this whole thing here because it's a completely separate presentation. But I talk about the business model of banking a lot because I've been passionate about it for a long time in terms of automating that model. And if you look at any institution, it's not just banks, but they have a back office that manufactures the products and services where they focus upon the innovation. They have a middle office that does all the processing that focuses upon operational excellence, get it right first time, every time. And then they have a front office that's doing all the love things, customer intimacy, experience, developing relationships. And that's good. Some people say that you can't be good at all of those things. You can only be good at one of those things. But we all try and be good at all of those things, but often we're only good at one of those things. And yet, when you look at what happened in the 1990s when the big banks got bigger until they became too big to fail, what they ended up doing is they expanded into all lines of business. So they bought insurance companies, they opened wealth management operations. Some of them even tried to go global. And I look at this and I go, that's a broken system because you can't be good at everything, everywhere, for everyone, all the time, every time. You're going to be rubbish at something. You're going to fail somewhere. So if you can't be good at everything, everywhere, for everyone, all the time, every time, you need to change. Now, you could do this structure in an old physical distribution system because you could control the system. But in the digital world, The back office is now just components of plug-and-play software that through APIs in the middle office you can plug and play anywhere and put into the front office through apps and services to anyone to develop the user experience. That's the reason why all these fintech startups are out there, saying any line of business in the back, middle, or front office, we can change the game. And so if I am a large global bank with a distribution model based around a physical structure, what I have to do is turn it into a digital distribution structure and recognize I can't be good at everything everywhere all the time, every time, with everyone. So what I have to admit is I'm rubbish at a lot of stuff. But I'm pretty good at maybe integrating this web for my customers to get the best possible service at the lowest cost in real time. So the value systems integration of the value chain is where the financial systems incumbent players are developing. It's the reason why you see people like BNP Paribas launching Hello or AXA launching soon. It's developing into a new economy, a new service, a new value web-based service in real time that's nothing like the old financial system. It wipes out the old financial system of buildings and humans and replaces them with software and servers, but recognizes that where you need buildings and humans, they sit on top of the softwares and servers, rather than the other way around, where the software and servers sit on top of the buildings and humans. That's the change from physical to digital. Turn it on its head as a value systems integration structure of the value chain. Challenging, but that's what we have to do in this third generation of the web. But this is only the first phase of this third generation of the internet, the value web. And the reason why we have to have this is when you look at what's coming next. Because what's coming next, and you heard some of this morning from Chris Anderson, yesterday from Salam Ismail, is obviously a thing called the Internet of Things. I prefer to call it the sensing internet, where everything becomes intelligent. So the web can sense that I'm here, what I'm doing, where I'm going, what I'm thinking. The sensing internet is an intelligent web that revolves around me and augments my life. So the augmented web, if you prefer. I don't care what we call it. But in this new augmented sensing web, we will have an average of 15 devices per person. A fridge, a car, a phone, shoes. Shoes that are intelligent. And in the web of things, where everything's connected, we'll see changes. I was recently in Eastern Europe, and one of the banks took great delight in showing me their app, where as they drove into the gas station, they could order their fuel through the app. And they ordered 20 euros of fuel and got gas for 20 euros from the attendant and drove out. But the key thing about that experience is it was minus 30 degrees in November in Eastern Europe, and they'd never had to open the car door, which was the reason why they thought it was cool. And I said, you know what? Very soon, I don't see why you're using the app, because your car will order its 20 euros automatically. It'll know how much it needs. It'll drive itself into the station, where a robo-attendant will fill it with fuel, if it needs fuel, because it's self-driving on the internet using electricity, so maybe it gets a different form of fuel. You know, when we're in the Internet of Things, you don't do things. Your things do things for you. And so in that Internet of Things, they have to transact and trade on your behalf. So they become your things that are transacting. And if they're transacting, they have to authenticate and be recognized through the system. And so there's a whole new way we're going to build and extend the value web, many of these capabilities being based around a digital identity of you recorded on the blockchain, or something like the blockchain. And that's really the fundamental shift, in that you heard Chris talk this morning around third industrial revolution. I actually don't think we're in an industrial revolution, but we are in a network revolution. And when you look at the network revolution we're going through, every time we go through a revolution in trade and finance, we go through a revolution in money and currency and value. When the bartering system broke down because of the agricultural revolution, the ancient Sumerians 5,000 years ago invented coins, money, because there was an abundance of overproduce, too many goods and services, maize, wheat, being produced. So they had to find another way to exchange the value of the overproduction. And they created money to pay for the overproduction. That was good for 5,000 years. It's still good today. But when we got into the Industrial Revolution, where we're moving around the world, we needed a new form of lighter currency, because Coins typically were gold and silver and too heavy to carry around in your pocket and purse. So we invented paper. And by inventing paper, we invented banks. And banks are licensed by governments to issue paper, checkbooks. And that enabled us to have the Industrial Revolution through trade and finance and a new form of value exchange based on paper exchange rather than currency exchange. But when we moved from factories into offices in the 1940s and 50s after the war, we needed another form of currency because it takes a long time to write a check. And if you're entertaining clients because you're now working in an office, writing out a check at the end of your meal is a pain in the backside. So we invented plastic cards to exchange as value. Now with chips inside everything, we will be transacting in a different way again, because chips enables us to transact and exchange value wirelessly through the air without any physical exchange of cards or cash. That's the big point of the value web again. It has to be underpinning this to enable machine-to-machine commerce, where machines can trade through chips with each other intelligently. It's the reason why you never see anyone pay for anything on Star Trek. It's just wireless debits and credits through the air. Then we get into the internet on demand, where when 3 and 4D printers can be in our homes rather than in factories, we can print anything. Already we're talking about Amazon printing our Blu-ray and CDs in the vans and our books, so we get them within 60 minutes of the order. But why should I get it from Amazon? I just print it. I can print anything. If I have the right printer, I can print a car, fashion, jewelry. I can print guns if I want to. I can print human cells, as you heard. Very soon, and I'm talking now about probably 7 to 8 years away from now, everybody will be printing everything at home. So why then do you have a supply chain? Why do you need to order stuff from China? You just print it. In fact, on that point, the supply chain disappears. We talk about supply chain. Companies in the age of on-demand will have to shift to being designers, providing specifications that we pay for to print at home. Why should I buy it and get it sourced? I want to just see it right now. And very soon after that, and we're already again seeing this emerging right now, the Internet of bots becomes pervasive and everywhere. And we're already seeing robots appearing in lots of places. Japan's very much into robots. If you can't tell which one it is, it's the one with the funny legs in the middle. Robots are appearing everywhere. In Japan, they like them so much that they're replacing their humans in branches. In Britain, our humans in branches appear like robots. It's very similar. So gradually, we're moving towards automating everything. And right now, there's a lot of advisors starting to appear as robo-advisors. So the robo-advisors are things like Betterment and Wealthfront and Personal Capital, where you can get all your advice for your wealth, your assets and liabilities, wrapped up in an automated system that gives you the best advice from the machine rather than from the human. Again, replacing everything with machines rather than having humans doing the work. It's the core focus that we have in this value web generation. It's the reason why there's an old joke that goes around about, in the very near future, the whole of financial services will be run by one man and his dog. The man is there to feed the dog, and the dog is there to stop the man touching the computers. We're very nearly there. We're very nearly there. So the third generation internet is all about having the value web underpinning the ability to transact between machines, many to many. The M2M machine structures cannot be enabled if they can't transact between each other into form of value. And that's not just machines, but it's also allowing all this automation of the on-demand and the robot services to allow them to function. They can't function without the underpinning of the value web. And the value web actually goes a lot further, and I'm skirting over some of the top here, because the value web, to me, goes not just into currencies and money exchange between machines, but how we think about the things we value. Why do we store all our memories in Facebook? How much do you value your memories? What would it mean to you if your Facebook page was deleted? What would that mean tomorrow if suddenly it wasn't there? Why do you trust Facebook to store your life? The average baby born today, according to scientists, will live to the year 2165, to the age of 150. How is that baby going to find its memories? They won't be able to read Facebook in 2165. It won't be there. Why do you trust your memories to something that has no license? The value web needs to have a trusted store of value that's not just money, but of memories. It goes a lot further. But finally, when we get into the final next generation web, and I've no idea how this one will develop, we get into the fourth generation of the internet around probably 2030. About 15 years. This is the Ray Kurzweil internet, where it's so intelligent it feels like part of us. And actually that is the point. It is so intelligent, it is part of us. By this stage, we won't be talking about digital, physical, mobile. We'll just be saying it's the immersive web that's just our sixth sense. It's just part of us. You won't go, I'll just Google that. You'll just think the question and get the answer. The immersive web is part of us. We're integrated into the web by this stage. And by that time, I've no idea what we'll be talking about, but it'll be very different, I'm sure. So those are the 10 phases of the internet, the 4 generations. And the reason why the value web that we're going through right now is so critical, because that changes fundamentally everything in finance and also in the way we think about our lives. The first one started with one-to-many, controlled by companies. The second one led to consumer, where we were connected to each other one-to-one. Now we're talking about machines being connected across the planet, the Internet of Devices, the Internet of Things, the sensing Internet. And finally, in the immersive web, everything serves us as individuals, because we're immersed in it like the sixth sense. And when you think that that's maybe dramatic change, it's not, because things are changing very quickly, but they're not that quickly when we think about how we're evolving with it. We don't see these things like the Apple Watch, the iPhone as dramatic shifts. We just go, oh, that's cool, I'm going to have that. The internet itself is only a few decades old. The first computer was invented in 1946. It was actually developed during the Second World War to do weather forecasting, but unfortunately arrived too late. But the first computer was the ENIAC in 1946. So the internet is only 70 years old. And this technology is only 70 years old. We're still in very early days. If we were really developed, we'd never see this. Why the hell do we have this? So we're really in the early phase of this revolution. And when we talk about the last revolution, the Industrial Revolution, it actually began in the 1600s, in the early 17th century, when steam was first being used for power and warmth. But it took over 200 years before the first steam engine appeared in 1825. 200 years to get this technology to really work, to enable this revolution to take place of the Industrial Revolution. And then it took another 100 years for that revolution to pan out. So it took 300 years from the technology being identified to the real change impacting the planet. We're only 70 years into this one. I have no idea what will happen in the next 230, but I'm looking forward to it. Thank you very much.